In October 2025, China's holdings of United States Treasury bonds fell to $688 billion. This represents the lowest level since 2008 and marks a decline of nearly half from the peak of $1.3 trillion held in November 2013. What most Americans don't realize is that this quiet, systematic sell-off is not simply financial housekeeping, but rather the opening move in a fundamental restructuring of global monetary power. The $17 trillion figure in this documentary's title does not refer to what China currently holds. It refers to something far more significant: the total amount of foreign-held United States debt that could potentially enter the market if confidence breaks. As of the first quarter of 2025, $9 trillion in marketable Treasury securities were held by foreign investors, representing 32% of all outstanding debt. When you add to this the Federal Reserve's continued balance sheet reduction and the domestic institutional investors who would rush for the exits in a panic, you approach a $17 trillion wall of potential selling pressure that could overwhelm the world's most important financial market. This is the hidden mechanism that could trigger the greatest monetary crisis in modern American history. Throughout economic history, the collapse of great powers has followed a remarkably consistent pattern. It begins not with military defeat or natural disaster, but with the quiet erosion of creditor confidence. When foreign lenders stop believing in a nation's ability to service its debt, they begin to sell, and that selling creates the very crisis they feared. The mechanics are straightforward but devastating. A government borrows in its own currency, spending beyond its means to fund wars, social programs, or economic stimulus. Foreign creditors initially accept this arrangement because they trust the currency and need a place to park their reserves. But when debt grows too large relative to the economy's productive capacity, doubts emerge. As creditors reduce their holdings, bond prices fall and yields rise. Higher yields mean the government must pay more to borrow, which increases the deficit, which requires more borrowing, which further undermines confidence. This self-reinforcing spiral has destroyed the fiscal credibility of empires from ancient Rome to modern Europe. In August 1982, Mexico shocked the global financial system with a simple announcement. The country's finance minister informed the United States Federal Reserve and the International Monetary Fund that Mexico could not meet its debt payments. At that moment, Mexico owed approximately $80 billion to foreign creditors, an amount that had doubled in just 3 years, as global banks flooded emerging markets with easy credit during the oil boom of the late 1970s. What made this crisis systemic was not Mexico alone, but the domino effect it triggered. Within months, Brazil, Argentina, and more than a dozen other Latin American nations found themselves unable to service their foreign debt. The combined external debt of the 17 countries most seriously affected reached $392 billion, of which $291 billion was owed to commercial banks. For perspective, this amount exceeded the total capital of the major Western banks that had extended these loans, meaning a complete default would have collapsed the global banking system. The crisis had 3 interconnected causes. First, the Federal Reserve under Chairman Paul Volcker raised interest rates dramatically to combat United States inflation, pushing the prime rate above 20% by 1981. Since most Latin American debt carried variable interest rates tied to United States benchmarks, their debt service costs exploded overnight. Second, global recession reduced demand for Latin American exports, cutting the foreign currency revenue these nations needed to repay dollar-denominated debt. Third, the dollar itself strengthened sharply, making every dollar of debt more expensive in local currency terms. Nations that had borrowed heavily when conditions were favorable suddenly found themselves trapped in an impossible situation. The International Monetary Fund and World Bank intervened with emergency loans and restructuring programs, but the price was severe. Latin America entered what became known as La Década Perdida, the lost decade, characterized by economic stagnation, soaring unemployment, and collapsing living standards. The lesson was clear. When foreign creditors lose confidence and withdraw funding, even resource-rich nations with growing populations can face economic collapse. The only reason the 1982 crisis did not spread beyond Latin America was that most developing nations at the time had limited integration with global capital markets. Today's world is far more interconnected, which means a creditor confidence crisis in United States debt would have nowhere to hide. Between January 2022 and December 2024, China reduced its official Treasury holdings by more than 27%. From approximately $1.040 trillion to $759 billion. By October 2025, this figure had fallen further to $688.7 billion. The pattern is unmistakable. China has sold $173 billion in 2022, $50.8 billion in 2023, and $57.3 billion in 2024. The pace has not slowed in 2025. This is not panic selling. China is conducting a strategic, orderly reduction of its exposure to United States sovereign debt. The reasons are multiple and overlapping. First, geopolitical tensions between Washington and Beijing have made Chinese policymakers wary of holding assets that could potentially be frozen or seized in a conflict scenario, as happened to Russia's foreign reserves after 2022. Second, China's trade surplus with the United States has narrowed, meaning less need to recycle trade dollars back into treasuries. Third, China has been diversifying its $3,346 billion foreign exchange reserves into gold, which the People's Bank of China has purchased for 13 consecutive months as of November 2025, and into other currencies including euros and yen. Meanwhile, the broader picture shows fractures in dollar hegemony. The dollar's share of global foreign exchange reserves fell to 56.9% in the third quarter of 2025, the lowest level since 1994. At the same time, United States government debt has exploded to $38.4 trillion as of December 2025. Up more than $7 trillion since December 2020. The debt-to-GDP ratio now stands at 98%, and the Congressional Budget Office projects annual deficits will exceed $1,900 billion in 2025 and reach $2,500 billion in coming years. The most alarming development is the rising cost of servicing this debt. In fiscal year 2024, the United States paid $882 billion in net interest on the national debt, representing 13% of all federal spending. This exceeded the entire defense budget and is projected to reach $1 trillion annually by 2026. The average interest rate on marketable debt reached 3.4% in July 2025, more than double the 1.6% rate from early 2022. Every percentage point increase in rates adds hundreds of billions in annual interest costs because the Treasury must refinance trillions in maturing debt each year. At the same time, the Federal Reserve has been reducing its own Treasury holdings through quantitative tightening. From its peak of $8,900 billion in 2022, the Fed's balance sheet fell to $6,500 billion by 2025, a reduction of $2,400 billion. This means the Fed is no longer the buyer of last resort absorbing government debt. The Treasury must find new buyers willing to accept lower yields, or it must pay higher rates to attract capital. With China selling and the Fed stepping back, the burden falls increasingly on domestic investors and whatever foreign buyers remain confident in dollar assets. Japan, now the largest foreign holder of United States Treasuries at $1,200 billion as of October 2025, has actually increased its holdings slightly. But Japan faces its own fiscal crisis, with government debt exceeding 250% of GDP, the highest in the developed world. There are real questions about how long Tokyo can continue absorbing United States debt while managing its own fiscal pressures. If Japan, like China, begins reducing its Treasury holdings, there would be no major foreign buyer capable of filling the gap. The mathematics of the situation point toward 2026 as a potential inflection point. The United States Treasury must refinance approximately $7 trillion in maturing debt each year while simultaneously borrowing an additional $2 trillion to cover the annual deficit. This means Treasury auctions must successfully place roughly $9 trillion in new and refinanced debt annually. Under normal conditions, this is manageable. But these are not normal conditions. If foreign buyers continue reducing their holdings at the current pace, the Treasury will need to attract approximately $1 trillion in additional domestic and remaining foreign demand compared to 2024 levels. This additional demand must materialize even as interest rates remain elevated and as concerns about fiscal sustainability grow. The mechanism through which markets enforce discipline is straightforward. If buyers are scarce at current yields, Treasury auctions will fail to meet their targets unless the government offers higher interest rates. Higher rates make the debt burden worse, forcing even more borrowing, creating a feedback loop. Consider what happens if 10-year Treasury yields rise from their current level around 4% to 6%. On $38 trillion in debt with an average maturity of roughly 6 years, this would add approximately $800 billion annually to interest costs once the entire debt stock has been refinanced. Combined with existing deficits, this would push the United States budget deficit above $3 trillion per year, or approximately 10% of GDP. At that point, debt dynamics become unstable, with debt growing faster than the economy's ability to service it. The international monetary implications extend beyond Treasury markets. The dollar's role as the global reserve currency depends on foreign central banks' willingness to hold dollar assets. If major holders like China continue selling treasuries, they must also convert the dollar proceeds into other currencies or assets. Large-scale dollar selling puts downward pressure on the currency, which in turn makes imported goods more expensive for Americans and adds to domestic inflation pressure. This forces the Federal Reserve into an impossible choice: Raise interest rates to defend the dollar and support Treasury auctions, or keep rates low to support economic growth and accept currency depreciation and higher inflation. Meanwhile, alternatives to the dollar system are emerging, however slowly. Saudi Arabia has discussed accepting Chinese yuan for oil sales, though this has not yet materialized at scale. The BRICS nations have explored creating alternative payment systems to reduce dependence on dollar-denominated trade. While the dollar's displacement is not imminent, the direction of change is clear. When the world's largest exporter, China, and major resource exporters begin transacting in alternative currencies, the volume of dollar recycling into Treasury securities naturally declines. This gradual erosion of dollar dominance creates the conditions for a sudden confidence break. The conventional wisdom in Washington holds that concerns about dollar dominance and Treasury market stability are overblown. Proponents argue the dollar has no viable alternative. The Treasury markets remain the deepest and most liquid in the world, and that reports of America's fiscal crisis are exaggerated. This view is not entirely wrong, but it is dangerously complacent. The insight that history provides is this: monetary crises do not announce themselves with obvious warning signs that everyone recognizes simultaneously. Instead, they develop gradually through years of accumulating imbalances until a relatively minor trigger causes the system to break. The Latin American debt crisis began with Mexico, but the vulnerability had been building for years through excessive lending and deteriorating fundamentals. The 1976 sterling crisis that forced Britain to seek an International Monetary Fund bailout came after years of deficit spending, and inflation eroded confidence in the pound. The European sovereign debt crisis of 2010 to 2015 emerged from structural imbalances that had existed since the euro's creation, but were ignored during good times. The United States today exhibits the classic warning signs of an approaching creditor confidence crisis. The debt burden is rising faster than economic growth. The largest foreign creditor is systematically reducing exposure. Interest costs are consuming an ever larger share of federal revenue, reaching 18.4% by the end of 2025, exceeding the previous high set in 1991. The political system shows no capacity for fiscal adjustment, with neither major party willing to cut spending or raise sufficient revenue to close trillion-dollar deficits. The Federal Reserve's tools for managing a crisis are constrained by already elevated debt levels and persistent inflation risks. What makes 2026 particularly dangerous is the convergence of multiple trends reaching critical thresholds simultaneously. China's Treasury holdings are approaching levels where further reductions would be difficult without disrupting markets. The Federal Reserve has ended quantitative tightening but has not resumed large-scale purchases. Interest costs are about to cross $1 trillion annually. The presidential election cycle creates political uncertainty about fiscal policy, and global geopolitical tensions remain elevated, increasing the risk of a sudden confidence shock that triggers accelerated selling. The $17 trillion endgame refers to this potential cascade. If confidence breaks and foreign holders begin selling in earnest, domestic investors will not step in to absorb the supply without demanding significantly higher yields. Higher yields make the debt unsustainable, forcing even larger deficits, confirming the fears that triggered selling in the first place. The Treasury market, despite its size and historical stability, is not immune to the dynamics that have destroyed confidence in sovereign debt throughout history. The contrarian insight is that the greatest risk to American prosperity comes not from external enemies or economic competition, but from the internal arithmetic of compound interest on an unsustainable debt burden. China's Treasury sell-off is not itself the crisis. It is the signal that the world's largest creditor has calculated that America's fiscal trajectory is unsustainable. When your biggest lender quietly heads for the exit over a period of years, the prudent response is not to dismiss their concerns, but to ask what they see that you might be missing. The United States has considerable advantages: the dollar's incumbency, deep capital markets, military strength, technological leadership, and demographic dynamism. These advantages can buy time, but they cannot repeal mathematics. Debt must eventually be repaid or inflated away, and creditors are not obligated to continue lending at favorable rates when the trajectory is unsustainable. History suggests that when confidence breaks in sovereign debt, the adjustment process is brutal, swift, and beyond the control of policymakers who waited too long to act. The window for orderly fiscal adjustment is narrowing. Whether American policymakers will use that window or continue sleepwalking toward a creditor confidence crisis will likely be determined in the next 12 to 24 months. China's behavior suggests they have made their assessment. The question is whether America will make the difficult choices necessary to prove that assessment wrong, or whether the 2026 crisis will prove to be the moment when decades of fiscal denial collided with the reality of creditor discipline.